We start today's market talk. Under any outcome, a bottom-up stock selection works reasonably well. So this is what the investors need to focus on now, because the coming year will be a challenging one due to geopolitical uncertainty, US elections, China's economic slowdown. But if you see, long-term India story is intact and there is adequate domestic liquidity support. So hence, if you do your stock selection properly, you would do reasonably well, and you don't have to chase momentum stocks or something like that. Market outlook. Uh, October has given us plenty to think about in the markets. In October, FIs have sold roughly 92,000 crore in Indian equities in a month, post China's announcement of economic stimulus. Stock fundamentals were stressed, and some of them are still stretched. And the markets, some of the stocks will remain expensive even if the SIPs remain resilient. Look at the stock market from three angles: fundamental, technical, and liquidity, and none of them look great at the moment. Fundamentals are stressed, earnings have not been able to catch up with the valuations. Nifty and mid caps and small cap indices have broken below the channel of higher highs and higher lows. So technically, it is looking weak. Coming to liquidity, if mutual fund flows, especially SIPs, get impacted, we can expect a future DI support to the market to also dwindle along with FI's support. Now, what are the major problems? First is sluggish urban consumption is impacting or affecting corporate results. We have seen the corporate results of HUL, Nestle, Tata Consumer, where the revenue growth lacked expectations. Bajaj Auto, TVS Motor had a subdued quarter. Dalmia Bharat and Ultratech face slowdown. Bajaj Finance is facing a higher credit cost issue, which is pulling down the profits. And in a market which is priced to perfection, the risk reward potential is unfavorable. Uh, Rich valuations will impact Bajaj Housing Finance, even if the results were decent. LTI Mindtree, TVS Motor, Polycab, Pidilite, and I don't see any listing gains for Fcon's Infra IPO also because it is fully priced. RBI has turned its scrutiny on the microfinance sector. After June quarter showed sharp increase in delinquencies in MFI loans, NBFCs, what has happened is NBFCs have grown their microfinance loans aggressively despite rising defaults. So as to inflate their NIMs, they were charging higher rate to borrowers along with poor assessment of their incomes. Hence, there is a total rise in NPAs, and RBI banned select NBFCs from giving loans. Now, this stress in these MFI sector and unsecured credit is being reflected in corporate performance. One of them was IndusInd Bank, where the shares crashed 19%, and they are the latest to warn of microfinance loan stress. It reported a drop in second quarter profit due to rise in bad loans. Provisions for the quarter rose 73% Q on Q and 87% year on year. Now coming to weekly data, Nifty corrected around 2.71%. Bank Nifty was down 2.51%, slightly lesser than Nifty, but roughly the same. Gold was higher, and silver was also higher, basically due to moving into safer assets. Crude oil was up, slightly up, basically due to uncertainty around Middle East. Natural gas was up around 13%. basically due to upcoming winter season. Dollar was also slightly higher because in periods of uncertainty, people move into safer assets. Used USD INR slightly was higher. India's 10-year bond yield also went up because there is no clarity right now on the rate cut scenario. And with rising food inflation, the chances of rate cuts are lesser in India. NSE market cap fell around 4.61%. That implies that the broader markets also corrected big time last week. Market-wide position limits is high, which indicates uh, that people have taken big positions, and this will trigger price volatility. Uh, Dow Jones corrected 2.68% based on poor results. Nasdaq was up 0.14%. It recovered due to Tesla's results, and S&P 500 also was down. Now coming to US, it had a volatile week. If you see, the bond yield sold off due to recalibration of Fed rate cut expectations, uh, which is also going to put pressure on equities. So if you see, the 10-year yield has now gone up from the low it made around 3.6 level and now has reached 4.2 because the expectations are lesser from rate cuts. US dollar index is also up, is now testing the declining trend line. If it breaks above this, then that would be a kind of a breakout. It took support at that 100 odd level. Brent crude, if you see, has bounced from that low of around 70. It has not been able to break that, but is not going up above these declining trend line or the moving averages. Gold maintains its momentum. It's on an upward trajectory now and has reached 2700 and plus now. So it is expected to, if it continues in this trajectory with rising moving averages, then shortly it may touch 3000 also. That is $3,000 to an ounce. Copper was subdued last week because there is no clarity on China's stimulus. So it went up and then it has corrected. And it went up 2, 3 weeks back because of China stimulus. But once there is no clear indication of that, so it has come down. Nasdaq, as I told you, was positive 0.14% last week, while Dow Jones corrected big time uh, because of disappointing quarterly results. While Nasdaq has made a 7-week high. GE Aerospace, 3M, Honeywell, Boeing had weak results. McDonald's share price came down due to outbreak of a virus due to on their burgers. This is what it is. Now India VIX was higher last week, so it was slightly volatile, and it is alternating between the level of 14 and 15 now. But in case the volatility goes up, then it will may head higher from here. Now coming to Nifty, uh, on the weekly chart, it made a bearish power candle, so which is very negative and broke the 20 EMA on the weekly charts and may test this second swing low of around 23,900 odd levels. If you see daily charts in terms of Bollinger Band, it tested the upper range of the Bollinger Bands, and now it is testing the lower range, which is somewhere around 24,035. So this is a level from where it bounced back on Friday. So watch out for these levels. On daily charts, it has broken that neckline of head and shoulder pattern and now may test the second swing low, which was somewhere around 23,900. Uh, and if this level breaks, then it may test this 200 EMA, which is 23,425 level. RSI is slightly oversold, so a bounce is due in Nifty. as such. On the hourly chart, if you see here, the Nifty has on the hourly chart, whenever it has become oversold, it has bounced back. So it became kind of a oversold on 25th, that is Friday, and then bounced back at the end of the day. But it is constantly trending downwards and trading below the 20 and 40, 50 day, 50 hourly moving average. So for some strength, it has to trade above these two averages for some. So this level of 24 590 becomes critical for it to trade above this level for some strength. Now, Nifty Bank on the weekly chart has also made a bearish engulfing candle, which is negative, and a breach of 20 EMA took place. It indicates nervousness. Uh, it may test the level or the lows it made on this election day event. Now, coming on to the daily chart, it is making a head and shoulder pattern, though it is not yet confirmed because it has to trade below this, where it will once it breaks this 50,000 levels, it will head towards this 49,640, which is the 200 EMA. So that is the next level where one should watch out for, where it is likely to take support and went up, and that should be the logical target of this downfall, because last time also it took support here. HDFC Bank is the only one stock which is providing some strength to this market and has not really corrected much. It is at till the time it is above this 1700 level, it is strong. Reliance has corrected, has now broken this support of 2680, and now it is testing the point from 2640 odd levels from where this whole rally started. So if this level breaks, then levels of around 2500 and then 2400 are likely. RSI is oversold. Midcap index, if you see here, is making lower lows now and lower highs. So it is now in a bearish territory. It has clearly broken the 100 EMA, and 20 EMA is also now breaking the 50 EMA. So that is a death cross. This should be the first level of support, somewhere around these levels, which was the election day high and which is also close to the 200 EMA. Small cap index similarly broken the weekly chart. It's making lower lows, and it is somewhere closer now to the uh, election day high. It broke around 6.45% last week. So this was the biggest weak sector, which was the most, which had displayed the most weakness last week. Now I'll cover three stocks. First is Persistent Systems. Management is confident of delivering broad-based industry-leading growth. Aim is to achieve 2 billion revenue by end of FY27. ACV and TCV trend is robust. ACV is annual contract value and TCV is total contract value. There is a decent pipeline of fresh orders. TCV came at record high of $529 million, up 14% Q on Q. Management is focused on developing platform embedded with AI capabilities to enhance software product lifecycle and services. Growth was driven by healthcare up 9.6% Q on Q and BFSI 7.7% positive Q on Q. High tech remains soft, which is flatter this week. Management aims for margin expansion in medium term with improvement in the range of 200 to 300 basis points. So it is around 14% right now. They are expecting it to go to 16 to 17%. Now coming to their quarterly results. So the Q and Q growth in dollars was around 5.3%. In rupee terms, it was 5.8%. Year on year growth was around 20%. EBIT margins came at around 14%. They are expecting it to go up 200 or 300 basis points. Profit after tax grew 6.1% Q on Q, and 23% year on year. See, the USD revenue is showing now a rising trend and growth, which is on an upward trajectory. Margin is stable, so it is not correcting as such, and they are expecting it to go up. Client concentration is reducing, so they are diversifying so that client risk is reducing, and TCV versus growth is good. So TCVs are going up, and their growth is also good Q on Q. BFSI vertical performed well, and healthcare and life sciences vertical performed well also in the last quarter, which is reflected in their Q and Q growth, which is around 5 to 10%, which is decent. Coming to their yearly growth, they're expected to grow in high teens, 17, 18% in next 2, 3 years. And the margins are expected to rise to 15, 16%, which will im improve the profit. Net profit should grow because margins are growing in 20 plus, 20 to 25%, the net margins will grow. So it is likely to do a EPS of around 111 in FY26 and 136 in FY27. So with a growth of roughly around 20 to 26%. So if you take a mean of FY26 and FY27 EPS, that comes to around 120. So 120, 50 times, it comes to around 6,000. That should be a fair value of this stock. The return ratios are improving, the turnover ratios are improving, liquidity ratios are decent, valuations are coming down in all P terms and EV/EBITDA also. So this stock is now becoming lesser expensive. If you see the chart, based on the result, this stock was at 50 EMA, and then based on the result day with large volumes, it went up. Now it's consolidating, but every dip to 20 EMA and 50 EMA is a decent buying opportunity. Between these levels of 5250 and 5400, there's a good opportunity to accumulate this stock for long term. Next stock is Sona BLW Precision. They acquired Escort Kubota's railway equipment division. It's a their railway division of Escorts Kubota was a market leader in railway brakes in India. Good financial investment, and it is expected to be earning accretive from the year one itself, and that is why the stock went up. Along with brakes, the railway equipment division is a top supplier of coupler, suspension, and friction products. Robust pipeline of new products, which is where it can make incremental delta or earnings growth. Some of the new products with high growth potential is electrical panels, HVAC systems, which is basically heating, ventilation, and air conditioning systems, and automatic plug door systems. Revenue share from the battery electric vehicles continue to drive overall growth in second quarter at rupees 317 crore, 53% up year on year. Net order book remained flat at 23,100 crores in second quarter. EVs account for 78% of the order book. Traction motors is the electric motor used for propulsion of vehicle. That current sales run rate is 20,000 units per month for two-wheelers, while it will commence supply to EV bus applications from first quarter current calendar year 26. They are doing well, and they are moving into broader mobility space, while earlier they were only restricted to electric vehicles or the autos. So if you see the year on year, net revenues were up 17%. EBITDA was up 14%, and PAT was up 18%, which is decent results. So revenue grew 3.5% Q on Q, and revenue growth is constant. EVs accounted for around 78% of the order book, which is maintained. Gross margins were slightly lower, but they are still decent at 50 plus levels. EBITDA margins contracted by 70 basis points to 27.3 levels, but above 25%, it's a decent margins. Now coming to their future growth. They're expected to nearly double their revenue from 3184 crores to around 6480 crores in next 3 years, which is good because it is still one third or one fourth of their total order book, which is 23,000 crore right now. The change is pretty good in 20% plus. EBITDA margins are likely to improve now, reaching around 28-29%, and PAT is likely to go up by around 30 to 40%. They're likely to do an EPS of around 16 rupees in FY26 and 21 rupees in FY27. So mid is around 18. So roughly around 40 to 50 times they are adequately priced. So 700 to 900 should be their fair value. EV EBITDA is coming down. So earlier their concern of high valuation has been taken care of. ROE is improving. Asset turnover is uh, becoming higher. So that shows that they are becoming more efficient. See their chart, it was coming down, it had come below the 200 EMA. And now, because of this news of acquisition of Escorts Kubota railway business, it spiked with high volumes and it has suddenly gone up. So at somewhere around this 670, 680 level is a decent opportunity to accumulate this stock. Next stock is Amber Enterprise. It's a leader in RAC manufacturing, enjoying 30% share, 20% share in RAC PCB, printed circuit boards. It also commands 25% market share across components except for heat exchangers and 41% in cross-flow fans. Since its IPO in FY18, it has strengthened its backward integration in RACs and diversified into non-consumer verticals, that is HVAC solutions for railways, metro, defense, bus, and commercial segments. So the advantage is that the RAC business, which was cyclical, concentrated basically to 2 quarters. That is the last quarter of the year and the first quarter of the next year. Now it is getting not the stock performance is not becoming cyclical because the other businesses are not cyclical. Its 25 manufacturing facilities spread across 9 states in India are strategically located closer to customer location, enabling faster turnaround. RAC revenue surged 104% year-on-year, aided by favorable weather and channel filling of RAC. Non-RAC revenue grew 68% year-on-year. It onboarded one new customer for Tower AC and converted a customer from gas charging to ODM. ODM is original design manufacturer, so the margins are higher. RAC demand in second half is expected to be strong, driven by channel restocking. So there is revenue visibility in the next few quarters. Acquisition of Ascent Circuits, which is now their subsidiary, and a joint venture with Korea Circuits has helped Ember to diversify into new business applications of printed circuit boards and bare PCB manufacturing, which has high potential for localization in India. So they are doing backward integration. They are coming up with a new plant in Hosur, Tamil Nadu, which will add annual capacity of up to 840,000 square meter in 2 phases, twice of current capacity. Total capex for this new plant will be 650 crore over 2 years. Net outflow will be 350 crore only due to government incentive and PLI subsidies. It maintains to double revenue in 3 years on a strong order book, 2,000 crore plus, and new product additions. AC demand has witnessed huge volatility in the last few years. Industry is poised to grow 3x, that is around 3 crore units in the next 5 to 7 years. So there is a big potential for growth. Now coming to their quarterly results. So the revenues were up 82% year on year and EBITDA was up 91% year on year. Consumer segment performed well. Basically, they operate in three segments: consumer durables, electronics, and railway subsegment. So the consumer durables and electronics did well. Railway was slightly subdued because I think railways are now diversifying more or focusing more on non-AC segment. EBITDA margins were also higher and improved decently. So that would have improved their margins and profit year on year. So their revenue EBITDA margins is showing a decent upward trend, though the business is more concentrated in uh, 2 quarters, but it is now improving. So if you have to compare it year on year, because there where the cyclicality comes in, expenses as percentage of revenue for raw material is coming down because of backward integration and all that. Employee expenditure was up and other expenses was also slightly up, but they are able to improve their margins. Revenue mix trend is now becoming lesser dependent on consumer durables, and now they are getting into more into electronics and railway subsystems and mobility. Consumer durables, excuse me, consumer durables revenue trend is improving, and now they are in a growth phase year on year. So if you see here, these 2 quarters are the quarters in which the consumer durables have maximum sale. Now, what they are doing is they are getting into electronics revenue, so which will reduce the cyclicality and railway subsystems also. So the trend is good for them for year on year in terms of growth. Revenue annual trend, if you see here overall, it is going up, and it is expected to go up 22 to 26% over the next 2 years. EBITDA PAT also is expected to rise. So EBITDA is improving and profit after tax will also improve. Margins are improving, now expected to reach around 8% in FY27, and PAT margin is expected to be around 3.7%. Now coming to their expected results, they are expected to nearly double their revenue over the next 3 years from FY24 to FY27. So a CAGR would be around 30%, and gross margins are also expected to go up to around 18%, EBITDA margins around 7 to 8% now, and EPS of around 98 in FY26 and 156 in FY27. So if you take a mean of around 120, 130, similarly, they can be given a PE of around 50 to 60 times. So they should trade at around 6,000 to 7,000. EV EBITDA is improving, actually going down, so it is becoming lesser expensive. ROE, ROC, etc. are improving, so they are becoming more profitable. Debt is under control. Seeing their chart, so if you see their chart, last few days they have been moving with high volumes, and then based on this acquisition and joint venture, and after the results, it went up but has corrected. So any dip towards this 5,400 odd level, 5,400 to 5,000 level should be a decent buying opportunity to accumulate this stock for long term. I finished. We will take questions now.